You've got this tension that seems to be coming through today between the inflation that we're seeing on the cost side and the opportunity that maybe exists elsewhere, particularly as interest rates start to go higher. How do you see that being resolved?
It's a really interesting question because you put your thumb right on it. There is a tension between these two line items on all the banks' profit and loss statements. And the expense issue is being primarily driven by compensation. The labor shortage is affecting the banking industry like many other industries throughout the United States. And that's pushing up these expense guidance numbers that JP Morgan Chase gave today. But the revenue side is also very interesting because there's optionality to the upside, in our opinion. Now, both JP Morgan Chase and Wells gave us good guidance on the net interest revenue. That's essentially the spread between what they earn on their assets and what they pay on funding costs. And in JP Morgan's case, that number is up 10% for 2022. That's their forecast. At Wells Fargo, it's about 8%. But if more interest rate increases come, that number could be higher. Now, both those companies assume rate increases, but would also say if the economy is stronger and loan growth is stronger, it would also be better for revenue. So the optionality is to the upside. That's how we win this tension, whereas the expenses, I think, are better controlled because they know what they're going to pay people in the upcoming year.
Gerard, we've been talking a lot about simply the rate hikes, inflation, targeting that, what the consumer pain threshold is. I'm curious what the pain threshold is when it comes to loan growth in particular. How does that translate into what you're hearing from the banks?
It's a good question because we know rising interest rates over time will eventually slow the economy down. It always has. And it really comes down to how aggressive does the Federal Reserve have to be to fight this inflation number. It appears to us that they're behind the curve, so they're going to have to move fairly aggressively to get in front of the curve to control inflation. And so to us, there will become a point, whether it's Fed funds rates at 3% or 3.5%, that would really weigh on the consumer and weigh on the economy. We think the economy can handle the first 150 to 200 basis points of Fed fund rate increases over the next 2 years. But if we go much higher than that, or if it happens much faster than that, that certainly could weigh on the economic growth, which would then weigh on loan growth.
Gerard, let's come at the Fed angle from a different position, and that's the regulatory side of the story. Sarah Bloom Raskin being nominated today by the White House. How big a headwind is she likely to be for this sector?
It's a really good question because the regulatory world has changed. This administration is not as supportive of the big banks as the Trump administration was. And with her nomination today, she, I think, is practical. We are a little concerned about her emphasis on stress testing the banks for climate change. Now, we heard yesterday from the vice chair nomination, Brainerd. She was saying very clearly, I thought, that the Fed would not tell the banks not to lend to the energy industry. So it'll be interesting to see how it plays out. But we need a new head of the controller of the currency. We need a new head of the FDIC. Now you have the vice chair of safety and soundness at the Fed being nominated. And generally speaking, they are going to be a little bit more challenging for the industry. The industry will manage it, but it's just not as supportive as what we had in the prior administration.
Gerard, it sounds like there's a lot of headwinds when it comes to banking broadly or to the banks broadly. At what point do you start to see some of these bank stocks peak, or have they already peaked? That was actually our question of the day at the top of the show. I'm curious what your thoughts are.
If we use the past cycles as a guide, we would say you own the bank stocks into the Fed fund rate increases. And that's what we're doing today. And the guide in the past has you stay with them for 3 to 4 Fed fund rate increases because it's not fully discounted, we don't think, in the market. Because after the 3rd or 4th Fed fund rate increase, whenever that comes, and let's assume it comes by year end this year, there'll be talk of more Fed fund rate increases, most likely, and that means higher revenue. So though it looks like there are some headwinds, and there are some, I wouldn't disagree with you, but we think the outlook still remains quite robust for the banks, especially relative to the market valuations. You might remember if this growth of value trade continues, like we saw in past cycles, there's still quite a bit of upside, we think, for the banks.
Can we just talk about Citi in a little bit of detail? You got an industry day coming up in March. I'm curious as to how quickly this company in particular, under Fraser, can reposition. Again, there was talk of that today on the call, but I wonder whether we're not, I just wonder how much detail we're going to get about Investor Day come March, and whether, how big a catalyst that's going to be in terms of wanting to own this stock.
I believe on their Investor Day, they're going to give us quite a bit of detail. And it's a turnaround story, no doubt about it. We're turning around an aircraft carrier. This is not a speedboat. It's going to take some time. Just the announcement last night of exiting the Asian markets, they put out an estimate of, by the time 2024 comes around, they should be completely out of those markets because of the regulatory approval process that it takes to approve these transactions. So we should anticipate as investors that the big news here is she's making real headway. Earlier in the week, you might recall, they announced they're leaving the consumer markets in Mexico. That was a surprise. That was not on the docket, whereas the Asian exit was on the docket. So I would expect that they're going to show us that they're shrinking the size of this franchise, making it more profitable by doing that, and taking any excess capital and giving it back to shareholders through share repurchases. And with the valuation disparity between them and its peers, the stock is very cheap. We think this is one of the stocks people can buy because we think that valuation disparity will narrow as Citi picks up on the valuation as they execute on this strategy over the next 12 to 24 months.